Three stocks that were in the news this week. Are they undervalued? Are they a buy? And at what price? As always, we're just going to look at the historical performance of these stocks in today's episode. We'll also take a look whether or not insiders have been buying or selling. We'll just touch upon their dividend safety, some of their financial metrics, and as always, we will run them through the valuation model, getting to the intrinsic value, as well as that acceptable buy price given our investor margin of safety, and touch upon Wall Street's forecast over the next 12 months. First one we're going to do very quickly, as we did do a deep dive just a few days ago, Visa. It was in the news this week. They did report their earnings and they did have a double beat. They are, as you can see, down 1.5% today. Although over the last year, up 19.5%. They are trading towards the 52-week highs with a yield of 0.76% and a forward PE of 27. Over the last 10 years, well, we can see this has been going up very, very strongly, 399%. Bear in mind, it doesn't include those dividends reinvested. Insider buying, where we're taking a look to see whether or not this are doing buys or sells. Now remember, insider buys, they're bullish. It's a bullish signal due to the fact management buy because they believe the share price is going up over the next few years. Insiders sell, many different reasons, personal, financial. With Visa, what is very interesting to see is that the CEO as well as the president in the technological department have been selling. And one thing I just wanted to point out, we can see from this column that they have sold at a much lower price than what it is currently. In fact, we can see the executive chairman who did sell in the beginning of November sold at a price of $236. As always, insider selling is just there for our information. It's not really a bearish signal as mentioned. In terms of dividend safety for Visa, 99, it is very safe. Market cap, 548 billion, mega cap company. Now, key metrics, increased the dividend during the last recession. Above average growth, as we can see, plus 9.5% versus the S&P's negative 12. Double-digit increases, as we can see, to the dividend. Double-digit over the last 5 years, as well as double digits over the last 10 years. Now, in terms of dividend increases, well, they have been increasing those dividends for the last 15 years. And when we take a look at dividend yield theory, this probably surprises a lot of people, but we have a sign of undervaluation, both on the dividend yield, as the yield is above the 5-year average, but as well on the forward PE, 26 versus the 5-year average of 29. But as we always say, bear in mind, we don't look at any of these models in isolation. Sector PE, well, 26 is what Visa, with financial sector at 11.1. And when we take a look at the earnings payout, remember it is susceptible to manipulation by management through accounting, so we draw your attention to the free cash flow payout. Below 60%, the preference for the majority of companies. Visa, what we love, in fact, below 30% every single year. 2023, 19%, very strong. So we are expecting more double-digit increases to follow. Free cash flow, very nice growth, 266 in 2014, 962 in 2023, so very strong, more than 3 times growth over the last 10 years. Sales growth, again, pretty much nearly double-digit increases every single year to the top line. We do get that negative COVID year, which can be justified in 2020. And for those that like to see the numbers, well, it has gone from 13 billion to 33 billion in 2023. On top of that, Visa do return excess cash to shareholder pockets, 2.52 billion to 2.07 over the last 10 years. ROIC, double digits every single year, 2023, 34%, very strong. Remember, my personal investment thesis, I don't invest in companies that have an ROIC below 10, because then I don't believe management are really able to effectively allocate their capital. Both operating margin and free cash flow margin, very strong for Visa, well above the minimums. In fact, probably some of the best margins you will ever see in any company. And the net debt to earnings before interest, tax, depreciation, amortization, remember, shows us the dividend safety as well as balance sheet strength. 0.05 in 2023, signaling it would take them 0.05 years to pay off all of their debt net of cash on hand. That is incredible. 3 is the maximum we look for. So for Visa, both that dividend looks to be safe as well as the balance sheet looking very strong. So let's jump into the valuation. Now, typically we do run through every single one of these models. Today's episode, we're just going to get straight into it as we have already covered this recently. The intrinsic value is getting to $303. Now, the current price sitting around $268 after it falling today after the very strong earnings report. Margin of safety, as always, we use 10% if we believe it has a wide moat, strong financial metrics, good forward-looking data. Now, personally, 10% margin of safety for Visa, in my own opinion, is acceptable. It is a strong company, probably has one of the best metrics for any company right now out there in the S&P 500. Other people will argue, though, they would expect a little bit of a higher margin of safety. 15%, 257, and at 20%, 242. In terms of Wall Street and what they forecast, well, they see the price going to around $293, so they have 9% upside over the next 12 months. The next company that was in the news this week was American Express. Now, they did in fact report today. It was fairly decent with a very positive 17% dividend increase. Now, as we can see, based on their earnings and their forward guidance, which they have raised 7.4% up today, up 30% or just under 30% over the last year, right there at that 52-week high. And over the last year, we can see a forward P of 16.75, forward P of 1.28. And over the last 10 years, this company has gone up 138%, excluding those dividends reinvested. Similar to Visa, we do see American Express vice chairman, in fact, insider selling. And again, similar, he has sold at significantly lower than the current trading price, around $158 to $168. Again, it isn't a bearish signal, but always interesting to note. What would be very a strong buy signal would when we see insider buying. So American Express dividend safety sitting at 80, market cap 137 billion. And when we take a look at those recessionary metrics, well, they maintained the dividend during the 07-09 crash, below average growth, and significantly trailed the S&P 500. Dividend growth, 15% last January. Like I said, just today they announced 16.7% increase to the dividend. Last 5 years, 9%, very, very strong. Last 20 years, 10%. We always love to see double digits. And now the dividend growth after today will have 2 years of consecutive increases. Dividend yield theory, well, we can see reasonable valuation with that yield pretty much in line with the 5-year average. But do note the forward P does sit higher, 17 versus 15.3. In terms of the sector P as well, American Express does sit higher at 16.9. Free cash flow payout was similar to Visa, very, very low. In fact, only 1 year where it's been above 20%. 2023 expected 9%. So again, we can see a regular theme with companies paying strong double-digit dividend increases where their payout is very low. Free cash flow per share, well, $6.90 in 2013, $25.60 in 2022. It has been increasing, which is always positive, but do note the inconsistencies. It isn't straight year-on-year increase to the free cash flow. Sales growth, we do see 2 years of negative growth, although we can understand somewhat that 2020 dip of negative 22%. 2023's 10% is very strong to that top line, and numerically we can see it has gone from 31 billion to 54 billion expected in 2023. On top of that, they have bought back nearly 30% of shares outstanding from 2013, 1.09 billion to 742. So that is very positive. As a shareholder, that is something you really do like seeing. ROE then, return on equity, again above 10%. The last few years in the mid-30s is a very positive signal. And the fact it has only really dipped to around 14% before recovering both times is also a very strong signal. Free cash flow margin, again, very, very, very nice to see. Again, when you do see companies that do have dips, it's always nice to see them rebound, which American Express have done. And 2023 is expected again to be in the mid-30s. So lots of positives to note here with AXP. Now, net debt to EBITDA isn't one that we would typically use for this company. And we can take a very quick look at the net debt to capital, essentially showing us the percentage of a company's financing from debt as opposed to equity. Whilst we look for below 0.4, it is nice to note 2023 is expected to be 0.13. So in terms of the valuation for AXP, let's jump straight in. And remember, you can always grab a copy of the valuation model to get to the intrinsic value as well as the acceptable buy price of companies in your own portfolio or on your watch list below. So what we can pretty much see, the current price around $203 isn't too far off the intrinsic value of $208. So right now, I would say, in my own opinion, AXP isn't trading at any kind of margin of safety. In terms of Wall Street and what they expect, well, Their price target of $200, as we can see, probably one of the few companies we see with upside negative. So similar to our calculations, Wall Street don't expect too much upside from American Express over the next 12-month period. The third company we are looking at today is PayPal Holdings. Now, we have selected this one as it was also in the news today. In fact, yesterday, after their CEO did say it was about to shock the world, well, pretty much after they did decide to shock the world in yesterday's event, it was down around 4 to 5%. And as we can see, in fact, over the week, it is down 8%. Over the last year, well, down 24%. And it is trading towards the mid to lower end of the 52-week range and a forward P of 12. Now, in terms of insider selling and buying, we do see, again, similar to the other two companies, insider selling by some of the important insiders in management team. And again, very similar, they both have sold at lower prices than what it currently trades at today. So it does have a market cap of 66 billion. It is a large cap company. And when we focus on the free cash flow per share, it has been increasing, but again, we do know inconsistencies. And one thing I would flag is that it is expected, once their 2023 annual report is coming out, to be lower than the last year. Sales growth, well, very nice to see double-digit increase year on year. 2022 and 2023 are expected to go into the single digits. So just something to consider whether or not you think PayPal's growth is starting to slow down after seeing those 8 years of consistent double-digit increases to the top line. And we can see it has increased fairly nicely over the period. Shares outstanding were 1.22 billion, now sitting around 1.12, so they have done some share buybacks returning excess cash, but it would be nice to see now, with the cheap price for PayPal, management doing a lot of insider, or in fact a lot of share buybacks. ROIC 10% or more, which is always great to see. 2023 coming in at 14% is nice for someone like me who likes to see a minimum of 10%. Both operating margin and free cash flow margin above the minimums of 12% and 5%, so no real worry. The free cash flow has dropped from the previous year, something to keep an eye on, but personally when they do fall, they have tended to rebound quite nicely the following year. And the net debt to EBITDA pretty much showing in 2023 expected to be 0, so they should have a very strong balance sheet, a ton of cash in comparison to their total debt, so there are no real worries with their safety. Now, before we jump into the valuation, just to let you know, we have started the second weekly newsletter, which was sent out just a few hours ago. We run through undervalued companies with strong upsides. If you do want to essentially get this free weekly newsletter, do click on that pinned comment below. So let's jump into the valuation for PayPal. Now, as always, the intrinsic value is just purely the average of the screen models that we have. $109 for PayPal in today's episode. Current price, $61.58. Now, margin of safety, 10% is what we use, remember, but PayPal in our eyes has some significant margin of safety. If we go to 45%, it isn't too far off that right now. So we see at least 40% margin of safety with PayPal. Now, Wall Street, what are they forecasting? They see a healthy 22% upside. They do believe it is a strong buy with a price target of $75. Let me know your thoughts in the comments below, whether or not any of these stocks that were in the news today, if you have been buying over the last few days or the last few weeks. And as always, let me know, smash the like button, and see you all on the next one.